Ponzi and pyramid schemes are often causing significant financial losses, especially among inexperienced and uninformed investors. These schemes are forms of financial fraud that convince victims to invest money by offering a high return on investment with little to no risk involved. Usually, both Ponzi and pyramid schemes offer no real product or service and are dependent on a regular inflow of money to remain active. But despite being related, there are some fundamental differences between the two models. A Ponzi scheme is an investment scam that works by paying off earlier investors with money collected from later investors. Victims are typically lured by false promises of good investment returns with minimal risk. Since Ponzi schemes have no legitimate way of raising funds, they are dependent on constantly victimizing new participants seeking promising investments. During the early stages of a Ponzi scheme, investors that get paid invite new participants as they believe it is a legitimate business. But as the system expands, it becomes increasingly difficult to pay the promised returns because it requires an ever-growing number of new participants. Eventually, the Ponzi scheme collapses, either because the scammer gets caught or because they disappear with the investors' money they have collected. Ponzi schemes are named after Charles Ponzi, an Italian trickster that moved to the US and became famous for his fraudulent money-making system. In 1920, Charles founded a company to promote his scheme, managing to defraud hundreds of victims for over a year. A pyramid scheme operates in the business sector and relies on network marketing. Pyramid schemes promise payments and rewards for members that not only join the system, but also manage to recruit new members. Therefore, each participant takes a commission before forwarding the money to the top of the pyramid. Most pyramid schemes do not offer a real product and are maintained solely by the money raised from the recruitment of new members. In some cases, the pyramids are presented as a legitimate multi-level marketing company that claims to sell a product or service, but are only used to hide the underlying fraud. So, what's the difference? Ponzi schemes are usually presented as investment management services, where participants believe the return they get is a result of genuine investments. The investors are not required to recruit new members to receive payments, but only to entrust the service with their money. Victims of Ponzi schemes often reinvest their alleged profits, which tends to delay the collapse of the fraudulent system. Ponzi schemes operate on the robbing Peter to pay Paul principle. On the other hand, pyramid schemes are based on network marketing and require participants to recruit new members to get paid. They tend to collapse faster than Ponzi schemes because there is an exponential increase in the need for new members. How to protect yourself? Be skeptical. An investment opportunity that promises quick or high returns with minimal investment is probably a scam. If it sounds too good to be true, it probably is. Do not trust, verify. A reputable financial advisor or brokerage company will be registered and monitored by governing bodies. Legitimate investments should always be legally registered. Make sure you understand the investment. You should never invest money in something you do not fully comprehend. Report. Whenever investors encounter a pyramid or Ponzi scheme, it is important to report these to the authorities. This will help protect future investors from becoming victims. Some may argue that Bitcoin is a big pyramid scheme, but this is simply not true. Bitcoin is a digital form of money that is secured by cryptography and computer code. It is a powerful tool that may be used to buy goods and services or to perform borderless financial transactions. Just as fiat money, criminals may use cryptocurrencies on pyramid schemes or other illicit activity, but that doesn't mean cryptocurrencies or fiat currencies are pyramid schemes themselves.